markets, we have seen a notable improvement in all confidence measures. Consumer confidence, business confidence, even home builder sentiment skyrocketed higher. So I think the question is, when does that increase in animal spirits actually start to translate to real activity? Typically, there's pretty decent lags between turns in confidence and turns of actual movement in the economy and investment and spending. But I think given the flow of the data, it's possible that we have some upside risks to today's report.
Steve says we're at full employment, and he's quoting a lot of economists who say we're at full employment. Are we?
Well, it's hard to know what full employment is, in the sense of it's hard to know what we consider neighbor to be, because it's kind of an abstract concept. That said, 4.6% unemployment rate, you got to be at least very close to full employment.
So the reason I ask is, if there is more, if we get an upside surprise, maybe it's not in the number, maybe it's in wages. Do we see it manifest itself in some other way?
To me, I think what might get the markets to really pay attention is if you actually have the unemployment rate stay at 4.6% or fall further, coupled with a faster than expected pickup in wages. That would send the signal that we actually could be reaching some period of tightening in the economy where inflationary pressures are building and we're already at that full capacity. So to me, that would be the interesting story, maybe even more important than the headline number.
Got it. What are you doing here, Mike, with as we wait for this number?
Well, first of all, Michelle and I were chatting before the show backstage. One of the things, if we do get a stronger than expected number, my concerns are now that actually this could wind up pulling the Fed back into play. If it's accompanied by an increase in wages and we don't see an increase in participation rate, what you start to see now is concerns that wage inflation winds up translating into higher finished goods inflation. And obviously, with the market now kind of focused on what the next steps in the Fed will be, that's something the market has to adjust.
So when you say the Fed's back in play, you mean more than the 3 that they've hinted at, or sooner than what they were thinking originally?
Yeah, well, again, as the Fed said, my view on the Fed right now is that the 3 dots, if you want to call it that way, in terms of what they expect to do in 2017, is now kind of the central tendency. Up till now, we'd viewed that as a ceiling. That was as far as the Fed would go. In fact, they often undershot it. I think there's risk now, just as much of a risk that the Fed could overshoot as undershoot in terms of rate hikes over the course of 2017. So I do think right now, and we certainly got this from the minutes, that we're seeing in terms of the payroll data now is increasingly important in terms of how the Fed's reaction function is.
What does that do to the market?
Well, again, it depends on how much we see. If we do get in line with 175 in consensus, Michelle and I were talking about, then I think the markets are going to be fine with that. If we get significantly over 200, if we see a big increase in average hourly earnings, then I think we start to discount prospects for a Fed rate hike.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.